Please note that World HD posts on social media may include statements concerning financial market trends and are based on current market conditions, which will fluctuate and may be superseded by subsequent market event. The investment strategies and broad themes discussed in World HD live streams, recordings, and social media posts may be unsuitable for certain investors depending on their specific investment objectives and financial situation. Information and data contained in posts and on live streams have been obtained from sources believed and checked to be reliable, but not guaranteed. You should note that the materials on the social media platforms are provided as is without any express or implied warranties. Past performance is not a guarantee of future results. All investments involve a degree of risk, including the risk of loss. Any comments made in the materials are opinions with no guarantee that any expressed course of events will actually transpire, and no compensation has been paid to any person providing a testimonial or comments.
Oh, say, can you see by the dawn's early light was so proudly we hailed at the twilight's last gleaming, whose broad stripes and bright stars through the perilous fight. Oh, the ramparts we walked were so gallantly streaming, and the rockets regular upon singing out, yeah, through the night that our flag was still there. Oh, say, does that star-spangled banner yet wave? Oh, the land of the free
And a very good morning to you on this December 4th, 2025. This is World HD, live each weekday, 8 a.m. Eastern Time, streaming live on X Rumble and YouTube. Just in case one of them goes down, it's streaming somewhere else too. So I don't know if many people have found it on YouTube. There are a fair amount of people that find it on X, which is good. And obviously, I think Rumble, where we have the chat and everything else, is good. And one good thing, so a lot of crazy things happen with technology, but today I found a way to actually put the chat up where I can see it better instead of having to look over. So that's a win. I think that's a win for us. Okay. Win for me anyway, because then I can see what you guys are saying, which is great. I can hopefully respond a little bit better. Okay. Sometimes it gets lost tucked over on these screens over here. All right. So good morning to all of you. Today's Equity Thursday. Is today Thursday? Oh my gosh. I don't even know. What is today? Do I have that right? Thursday, yeah. Thursday, December 4th. Okay. It's crazy. All right. Wow. Okay, this should be great today. We really got it together. Okay. All right. I think there's like 16 to 17 trading days left in the year. And we'll take a look at equities today, of course. We've been watching these stock markets closely. We'll talk a little bit about bonds, too. We're going to go through quite a few clips today. I want to go through... This claim that we have $21 trillion coming in foreign direct investment. I want to do so this will kind of be a first run at this, and it'll be probably our longest run at doing this. And then I think what I'll do is put together a nice list, because I have a list forming, but it's not really in presentable format. Today will be sufficient, I think, in what we're going to do, talking about this foreign direct investment. President Trump says we have $21 trillion of foreign direct investment coming in. We questioned him when it was at 7 and 10 and 12, right? And then all of a sudden it just, skyrocketed to $21 trillion. And today, we're going to look at some clips from Scott Bessent. He was out talking, and he's up for the National Economic Council to lead the National Economic Council as well. So I think this is Kevin Hassett's job. So that basically gives us, if that's the case, it gives us a good hint that the speculation that Kevin Hassett will be the next Fed chair is highly likely. I don't know. It could have even been announced. I mean, because they talk about, I see headlines, can Kevin Hassett get this done at the Fed? So I think there's already an assumption made. But so maybe it's announced and I just haven't seen it. I don't think so, but you can't rule it out. But I think this is a pretty good indication that Scott Bessent is going to not only be Treasury of the Secretary, but he'll also be head of the Economic Council, the National Economic Council, which is, I think, Kevin Hassett's job right now. Okay. So again, continues to lead us down the path that Kevin Hassett will be the Fed chair, Scott Bessent, the Treasury Secretary, Howard Lutnick, the Treasury of Commerce, and who knows what else. And then the National Economic Council will be Scott Bessent. So that gives us a pretty good feel for who's running what. Those are the big roles within the government from a economic and policy economic and financial policy perspective. Okay. And he talks about, one of the things I wanted to mention on that is Scott Bessent talked about how the 10-year note has had its best year in 5 or 6 years or something like that. So it's like, this is the whole thing, I don't know where they're coming from on some of these statements, because to me, if you were to say, again, that's what I want to question today is, why do we do this, right? Why do we throw out 21 trillion when it's probably 7 trillion or less? Okay. And we're not even going to know for a long time. And the sad part about, people, probably U.S. citizens as well, because we've been trained to be this way, is we get told something and then they can just not talk about it for a while, and then we forget. And then all of a sudden it's like, wait a minute, that's, that's kind of my job, right? Is to pay attention to things, look at charts, look at highs, look at lows, look at this, look at that, pay attention to all these different things. So somehow I kind of remember some of these things, and when I hear something, I'm like, that's not the way this was, and so why do we do that to ourselves? And why do we do this with the 10-year note? Because we don't need to, right? I mean, all you have to come out and say is, look, it's stable. We've got it stable. We're looking to bring rates down, and the 10-year note has been stable because that's the truth. I mean, this thing has been just riding that red upward sloping trend channel. It's concerning to me because at some point it's going to break, and I think we're going to get a spiraling out of control with high interest rates. And the reason we'll get high interest rates is because people will either have to be paid a lot of money to take on debt, or that's it. It depends on how bad it gets when we get a sovereign debt crisis. I guess I should say that. It's all in perspective. I don't want to go down that tangent today because that's definitely, we could go off on a long one on that one. But just leave it at this. I don't know what later on we're going to hear in this clip that Scott Bessent says in one of these clips. He talks about the 10-year bond. It's really not a bond; it's a note. Which is a little concerning to me. But anyway, that's just semantics, right? That's little details, but still important for someone who's running the Treasury and issuing all this debt to be definitive on that, because that's anyway. Again, just me being picky, I guess. But but why does he have to say this? And why does he say that it's, the best performing instead of just saying it's stable? These are the things that frustrate me. Okay. Another thing that Scott Bessent, this will be focused a lot around Scott Bessent today and this foreign direct investment. And another thing that Scott Bessent was out doing was he's pushing for residency for regional Fed heads. So remember, we have these different branches around the country, 12 of them plus 12 or 13 plus the New York Fed. I think it's 12 plus 1, which is the New York Fed. So it's 13 total. And he's pushing for them to have residency rules in that region. So I think that's a good thing. I think, again, right, it tethers people to their region and they have at least some stake in the game. What comes to mind when I think of this is Mark Carney, right? Now, again, that's outside the United States, but, Mark Carney is clearly probably the quintessential definition of a globalist because he's running the Bank of England, right? Head of the central bank of England. Then he's running the Bank of Canada, right? Then he's with Bloomberg and he's, running all kinds of conferences all around the world, right? For Bloomberg and essentially the World Economic Forum. And then now he's the Prime Minister of Canada and he says he has residency in the EU. So, I mean, those are the kind of things that, it seems to me you want to try to avoid with leadership. And that's what all these Fed regional leaders is they're sort of leaders in that region. They should be talking to local industry. They should have a vested interest set. Now, is it going to be perfect? No, but it's a step in the right direction, I think. And so that's a positive thing, so I'm going to try to, look, Scott Bessent calls some things out today, or yesterday. We're going to run the clips on this and I like it. I'm very leery of this guy. Just because of his connection to Soros and how much money he made Soros and his connection to Stan Druckenmiller. That was someone I saw in the chat yesterday. Someone said, what's his middle name? And his last name is Druckenmiller. So weird name, but probably one of the most underrated best traders of all time. I think he's gone like an insane number of years without a losing year, trading currency and different things. And that being said, are these guys bad guys? Ultimately, if you're making a bad guy like Soros a lot of money, then probably that links you. Whether these are hard calls, I mean, if it's going to be black and white, then yes, they have to be thrown in the camp of bad guys. If it's going to be areas of gray, you can say, well, he's not so bad here and he's okay there, and maybe he's doing a good job on this, and maybe. So if you're going to allow gray areas, then you could pick and choose, right? Of course. If you're going to say black and white, I think you just have to throw them in the camp of bad guys, because ultimately they're feeding the fire of a guy like Soros who's trying to destroy, our republic, constitutional republic, and by infiltrating judgeships, infiltrating any kind of political scene that he can, creating these riots, creating things whenever the time is right for he and his son, Alex Soros, to do these kind of things. So anyway, so that's Stan Druckenmiller, the trader we talked about the other day, who had the terrible comment about women in there. It's like I saw Trumpet throw that in there. Well, I think she was referring to that when he said what would he say? Something like if there's 6,000 women, only 20 or 30. It's just a terrible comment, right? Just the egotistical. Again, that's another thing to throw him in the bad guy camp. All right, but And if you don't remember it, then that's probably good. I was like, yeah, that's pretty cringy. I don't know, but I still want to run the clip because I think his trading concept is spot on, right? He talked about using technical analysis with fundamental analysis with technical. I think that's a very good approach, right? And sometimes the technicals can lead to the ideas, and then you start searching for why, right? That's how I like to approach it. I like to use the harmonics or the technicals and then come back and find what's going on, what would make this story play out. That's kind of what we're doing with this dollar, right? Even though it's a struggle, or at least I'm doing with this dollar. Okay, so again, a lot about Scott Bessent, a lot about foreign direct investment, and I just want to say good morning. This is great. I can just look right at it. So good morning, Crash and Splash Trumpet. I don't know why I didn't think of this before. Some things are mysteries. Good morning, Rachel. Good morning, everyone listening, but not really up yet. That's fine. That's fine. That's all right. Hopefully something in here will get you going. Okay. All right. Oh, Craig's laughing. Yeah, laughing at myself. Okay. Wall Street is saturated in debt. Yeah. Yeah. I mean, balance sheets are out of balance. Yeah. Well, and that's what we've been talking about, right? And in reference to, the AI or just Wall Street in general, if you can, I'd love for you to add to that, Bulldog. And good morning to you. Okay, Frank. Good morning, Frank. Good to see you in here, Gordon. The problem with the Fed is that it exists. Okay, okay, fair enough. I like that one. Okay, and TZ Burton. Good morning. I do remember his woman. Yeah. Okay. Well, Rachel remembers. So even though she's asleep, she remembers it. It's terrible. I mean, that's just a bad attitude. I mean, it's just a terrible. That's an insidiously bad attitude. When you speak like that. I mean, anyway, it's just okay. I'm just gonna leave it at that because it's just terrible. That is bad. Just good and there's bad and that is bad and it's just bad. Okay, Filippo, what is the trade to be in with the huge false flag in World War III or IV coming? Well, that's a great question. I think about that all the time, Filippo. I think that, if you look at this from a regional perspective and you say globally, where would World War III or World War IV break out and how would it look? If it's going to be like an electromagnetic pulse and cyber attack, then I don't think anybody's particularly safe. And I think it could be anything. And then that's why you want to have some physical gold. That's why you want to have a little bit of food in reserve, and the ability to grow food, right? And you want to be thinking about how would you defend yourself? Because just to give you an example, right? I had a friend who I went to graduate school with, Cuban guy from Miami, super great guy, right? He was before he came to graduate school, he had a background in, he worked as a not prison. I don't know what you would call it. But anyway, he was a prison guard in a prison. And when they had the hurricane that hit in Miami, he talked about how there were no police, there were no firemen, there was no one around. And he had to leave his home and his family, and he had to go in to watch the prison because you have to still guard the prison. Otherwise, it's going to break apart, and all these bad people are going to be on the loose. And he said it was truly a look at like what things look like if the system breaks down. That massive hurricane, I forget which one it was. It came in through Miami. I'm assuming it would have been like in the late 90s. Would have been sometime in the mid 90s, right? It was a really bad one. And it just shut everything down. And just a great guy. I mean, he was so funny. I need to reach out to him again and talk to him. We were great friends. And then time just, you just kind of drift apart. But just such a great guy. And but again, he had so many good perspectives on things. He's just a great kid, great guy. But he gave this idea, again, it planted the concepts in my head that how things could spiral out of control where you're on your own. I mean, you are on your own. And now it's temporary, but, so is it an EMP strike from one of these China balloons that floats over the U.S.? Is it cyber attacks? Because would that take out the whole internet or portions of it or whatever? So now you're like, okay, how do I think about that? I think those are some of the bigger risks to the U.S. And then obviously a financial debacle that just, melts the system down. That could do it too. But where we live each day, I don't think that that's so realistic. It, s- it could happen, right? There's a probability on that, and I mean, here I am, the one calling for potentially 15,000 in the Dow. That I can see reasons why it could come back to 15,000 in the Dow. Okay, from what 48 or whatever it's at now. So I mean, that's a major pullback. Do I? What's the probability on that? I don't know. I mean, ultimately, I think it comes back to that. At some point, it will come back to that line. It could be 20 years from now, and then at that point, that line's at 25,000 in the Dow. So at some point, there will be a massive sell-off. Again, if the charts and if things play out like they always have, right? Again, based on the sample size of 30 years of me doing this and doing all these trades and watching markets on all different fractals of time, I can say with a pretty good degree of certainty that at some point it will come back and test that. So could that be part of it? And what would cause that to happen? The other thing is, if it's going to be in Ukraine, if it's going to be in Europe, if it's going to be in Asia, okay, I mean, how isolated is the U.S. from that? And if that's the case, and I think the dollar is the trade, right? I think the dollar becomes the trade, or something related to the dollar. Maybe not the dollar, but another form of the dollar, something like that, as the dollar morphs into something else, because it's pretty clear that unless, like this is kind of a great, analogy or statement. Someone said, I don't know how World War III is going to be fought, but World War IV will be fought with sticks and stones. And so what that means is World War III will be so devastating that, it will be sticks and stones in World War IV. So if that's the case, who takes the biggest hit, if there is some sort of, and again, why do we say this? Well, because all the economic issues with Europe and the debt there, again, it's debt, right? I mean, we're talking about debt in the stock market, debt on Wall Street, debt in corporate balance sheets, federal debt, and it's all over the world, right? It's just massive. And so at some point, either the people are going to say we've had enough of this or the governments are going to fail. Okay. I think it's ultimately that. When that's going to happen, I don't know. I mean, so anyway, hopefully that kind of answers the question. I think what region would win, who would be the hardest hit based on what you think is going, based on, the next false flag. Look, I think Alex Jones has been out talking about this Podesta plan and that they're going to try to create a civil war. Martin Armstrong, who I've referred to multiple times in here, Armstrong Economics, he has a model. Again, I don't totally believe in it. I think he's a little bit fishy, but I think he does a lot of hard work. I mean, the guy's a worker, right? I mean, he puts out every single day, he puts out 2 or 3 4 sometimes well thought out posts. And his work, his research shows that I think it's coming in 2028 to 2032, we're going to have basically a civil war and a global war in that window of time. Okay. And so you see it starting to form, especially that's why I pay attention to this Podesta plan, that Alex Jones has been talking about. I mean, look, the guy's been right about a lot of things. I don't agree with him all the time, but again, you can't ignore Martin Armstrong. And I think it's dangerous to ignore Alex Jones. I don't take everything he says to heart for sure, but I think it's those kind of things that we're comparing, we're trying to take all this stuff in and then sort out what we think is reality. And I think we're at a pivotal spot. This dollar's, what's it going to do? What are the 10-year notes going to do? What's this gold market doing? I mean, I don't think gold's the perfect indicator because I think it's getting distorted, but I do think it's a good indicator. And then we look obviously at the stock market because there's so much money tied up in stocks. It's just a massive number. And the U.S. has the bulk of that, so, and this is why we keep, it's too much to just sit here and cover the whole thing in one thing. That's why we just try to break it apart each day. And then the goal is to sometimes talk about it like this collectively and just pull all those concepts of stock markets, debt markets, currency markets, commodity markets, what's going on there. I mean, it's a big part of all of our inflation that we get hit with all the time, or these food costs and people trying to solve those issues, cutting out the middleman, right? And that's a big part that's another whole thing, right? Cutting out the middleman. And who is the middleman, right? Who's the middleman on the medical side? Who's the middleman in the agricultural space? Who's this middleman, that's always out there? And are we kind of the middleman? Because, we work for these companies that are the middleman, and maybe we are part of being the middleman. I don't know. I mean, these are the things that we all talk about. Okay, so I think that gets us through Scott Bessent, foreign direct investment. That's the focus of today. And what I want to do here is roll this clip of Scott Bessent. This is actually, this is Scott Bessent being interviewed by Andrew Ross Sorkin on CNBC, who is a clown, in my opinion. You know, he's a smart clown, but he's a clown. And here he is talking to him and holding his ground with him that China is on pace to live up to all of its commitments from this China trade negotiation that we saw just a month ago, whatever it is. It's been about a month ago. So here it is. And Scott Bessent's giving it back to him, which is good to see.
You mentioned China. I want to discuss China for a moment, which is there is a deal, or we're working towards a deal in place. Part of the deal, the most recent deal, was that China was supposed to buy 12 million metric tons of U.S. soybeans. As of just about a week or two ago, they had only bought 330,000 by the end of this year.
No, by the end of the season. So I think that'll be February 28th.
So, okay, we're still at 300. If the 330,000,
I promise you, you can try to stir it up. They are in a perfect cadence to complete that goal.
But 330,000.
No. Again, bad information.
Bad information.
Bad information. If I look at the loadings, then their purchase by their central government is well into the correct cadence.
Okay.
So
let me ask you then a different question.
And I will say that China is on track to keep every part of the deal. Every part of the deal.
Okay. Pretty firm words. At the end, he says, every part of the deal. Okay. We'll see. You know, time will tell on that. Again, you know, do we have to be that firm on it? Do we really? Again, we'll just leave it at that. Again, every part of the deal per Scott Bessent. I'm not so convinced, but it's convincing, right? He is convincing when he says that stuff. Okay, here he is talking about Biden administration was one of the greatest scandals of all time. And I don't think any of us can disagree with that, but there's a lot more scandals that we can talk about. And, you know, and he's kind of been in the mix with them again, with George Soros, with Stanley Druckenmiller, you know, and taking down the British pound, doing all the things they've done to make Soros, you know, tens of billions of dollars. Okay. But anyway, here he is talking about the Biden administration being one of the greatest scams of all time. And it's good that he's pushing back on this. This is he's in front of the New York Times. Gets a fair amount of audience. I mean, this is bold. I mean, I don't understand why it's taken this long, but it is bold. This is great to see.
The question is, this is like a new, is this a new normal?
That, Andrew, there's no new normal. And, you know, I can tell you that I actually don't read the New York Times anymore. That sometimes I do watch CNBC, but, you know, occasionally people send me articles, and like there's just this fever swamp. And, you know, you're now a pop historian with 1929. And, you know, in 20, 30, 40, 50 years, the New York Times is no longer the paper of record. You can't go, I read this article, like President Trump is slowing down, President Trump's mental capacity. It is 100% fake. That, like, he only called me twice at 2 a.m. last week instead of 3 times.
You're saying he called you? I believe that he called you at 2 or 3 a.m.
That whole narrative. You had what was one of the greatest scandals of all time, that the coverage of the Biden administration, Joe Biden's diminished capacity, and the cover-up.
And that's why it's probably fair to raise these questions.
Where was the New York Times? We just had a 3-hour cabinet meeting yesterday, Andrew. For 10 months, the Biden administration did not have a cabinet meeting. How are you going to invoke the 25th Amendment if the cabinet secretaries never see the president? Which they didn't. That, you know, I hear from people in the Treasury building that I see President Trump more in a day than my predecessor saw Joe Biden in half a year.
So again, it feels good to see Scott Bessent throwing punches. And look, you know, CNBC, Andrew Ross Sorkin's on the morning show, and you have Joe, Curtin, he's on the right. And then you have Becky Quick, who's on, supposedly, in the middle. And then you have Andrew Ross Sorkin, who's on the left. And I don't know if they really, label them that way, like, right, middle, left, but it's pretty obvious when you watch it. And so the goal, I'm sure, behind that is to cover the full spectrum. And I've been really disappointed with Joe Kernan, to be quite honest, because he stands his ground a little bit, but not enough. And so, it's good to see this clown, Andrew Ross Sorkin, get pounded by Bessent. Anybody that pounds on him is a good thing to me. That being said, again, who is Scott Bessent? All right, he's talking about that cabinet meeting. Here is his portion in his comments during that cabinet meeting. A lot of things he covers here. He talks about, and this sets up the stage for this foreign direct investment stuff we want to talk about, where he talks about investment coming in, the big, beautiful bill, right? Talks about it from an industry perspective, it's expensing perspective for corporations, writing off a lot of things. So this goes back to some of the comments we've had in here this morning about the debt. And as they take on more debt or expenditures, again, you got a balance sheet, assets equal liabilities plus owner's equity. So, you've got equity, you've got debt, and then it all adds up to assets, and it balances out. When they take on these new expenditures, whether it's equity, out of equity, or it's out of debt, okay, for those of you who understand and who've done work with balance sheets, they're able to write this stuff off. So there's a tax overhang over this that gives an incentive, okay, to corporations to accelerate. They can accelerate the benefits. They can bring the benefits into today instead of having them over time, and that increases. It's like a B12 injection, I guess, to juice things up a little bit, or a little higher octane in your gasoline tank or whatever. It's kind of what they're doing with this, right? So again, he talks about that. He talks about energy certainty. He talks about, again, the best year in the quote-unquote 10-year bond, which, again, rubs me. And I sometimes say it too, the 10-year bond, but then I try to correct myself, the 10-year note. And again, it's just little things. It's semantics, right? And then he talks about low inflationary growth. And then he talks about 2026 setting up nicely for Main Street, okay? Not so much Wall Street. So what does that mean? If we get this big run-up in stocks, how are they going to separate things off? So Main Street, that's going to be fascinating to watch here, to see how they can say that this should be a good year for Main Street, or is it going to be a good year for Main Street and Wall Street? At some point, for this thing to work out, because remember, we talk about these things so out of balance. The 1% owns 50% of assets. The 50%, of the lower income earners only have 1% of the assets, right? Again, so it's very, very, a barbell, right? It's haves and the have-nots, right? And then you have obviously the others in the middle, and it's, we know or we've talked about the statistics on that. Anyway, that should set the stage for this whole thing in his cabinet meeting, and that's pretty much what he talks about. And this will set up the foreign direct investment stuff as well.
Mr. President, it's been a great year on the economy, but the best is yet to come. The tens of trillions of dollars that have come in investment, both the portfolio investment by companies, investment by countries, that it's turning into a CapEx boom for the U.S. Capital expenditures up 15% in history. That when CapEx is up, jobs will follow. The One Big Beautiful Bill is incredible, as you said. Thanks to your leadership, along with Speaker Johnson, Senator Leader Thune, we had that done on July 4th, which everyone said was impossible. And the great thing about that bill, sir, for the American people, it's for industry, 100% expensing. Build your factory here. You can write it off immediately. But you also insisted on the 4 benefits for working people. No tax on tips, no tax on overtime, no tax on Social Security, auto deductibility for American cars, and that is retroactive. So as a result, in 2026, we are going to see very substantial tax refunds in the first quarter. So the best way to address the affordability crisis is to give Americans more money in their pockets, which is what this bill has done. We're going to see real wage increases. I think next year going to be a fantastic year. Taxes, deregulation, energy certainty. That's why everyone with your leadership is coming to America. Bond market had its best year since 2020. Everyone said couldn't be done. So we're going to have growth. We've had 2 4% quarters before the Schumer shutdown. We're going to go back to that. So not only are we going to have great growth, but it's going to be low inflationary growth. And stock market obviously is following, but next year is going to be the year for Main Street as all this kicks in. And you came in, immigration, I called it the 3 I's, immigration, interest rates, and inflation, that were killing the American people. Close the border, the promise kept. Interest rates are down, and 10-year bond, again, best year since 2020, and inflation led by energy prices is going to roll next year. I think it's going to be a fantastic year. That we can look back, be very proud of this year, but I think 2026 is going to be great for the American people. Thanks to you.
Going to be great.
Okay, so it's a pretty good summary. I don't 2.5 minutes. He covers a lot of ground in there, and he talks about the setup for next year in 2026 and he really does a nice job of breaking these things down, I think. Okay. And before we go on to this foreign direct investment, and I think a couple of the key takeaways again for Main Street are the couple of the big takeaways: no taxes on tips or overtime or Social Security. And then the auto deductibility for U.S. cars. Again, trying to really push U.S. car manufacturing. And this has been a lot of the debate with Canada, the parts coming through Mexico, parts coming through Canada. And we'll see. We're going to see how this works out. But again, a great summary there. And well done. Well done, Scott Bessent. Okay, I got to give him credit where credit's due. Okay, and then I see David in here. Andrew Ross Sorkin is a slimy snail. Yeah, I agree. Not a huge fan of the guy. Okay. So one of the things I wanted to add in here before we get to the foreign direct investment is this stuff on. So Francois Macron. Okay, obviously he's been in the. For those of us in the alternative media space, we've probably seen Candace Owens going after Brigitte and Francois Macron and so that's been a thing. And Macron's sort of taken a backseat. He's been pretty quiet on the global stage. We remember we had the failure in the cabinet. They had the prime minister left, came back, Lecornu, and then, they tried to reform the cabinet, and it's been pretty quiet there ever since. And so Macron's now putting himself back on the global stage by going to meet with President Xi. And the question is, what were these guys going to talk about? Okay, so the key things on the table were rebalancing trade relations, helping mediate a peace agreement for war in Ukraine. Okay, so I don't really think that's they might put that as a headline, but again, Macron needs war. Europe needs war. They're looking for war. They continue. One of my goals is to, look through another lens, and hopefully, by doing this show, we're looking through a different lens, and it helps you find your own way of looking through a different lens. And one of the things I notice is when you look through a different lens on this, you can see that they say one thing about war because they're constantly saying, how do we create a peace deal with Ukraine? But if you really look what's going on, every single move they're making is to agitate. Okay. And that's the lens of stepping back and saying, okay, what they say this, but they really mean that. And everybody who's listening to this, I mean, you're well aware of this, right? Democrats do this, they say this, and then they do that, you know what I mean? Or so-and-so says this and does that. And that's why we're so sketchy with Lutnick and Bessent, because they say great things, and then they do this, And this is that underlying, I know some of you watch the technocracy stuff, TZ, and a few others in here have watched that. I mean, I think Patrick Wood and Courtney Turner and Aaron Day do a good job of saying, wait a minute, I know they're telling you all these things, but here's the technocracy perspective. And again, it's that other lens. So that's why, the overlying, it's another lens to look through. All right. And that's hopefully what we're getting out of here. So the concept here was for Macron and Xi to be talking about rebalancing trade, helping mediate a peace agreement between Ukraine and Russia, okay, which is just completely laughable. Trade and investment, okay, global stability again. what does that even mean? And then Macron tells Xi, this is one of his statements, that China and France must overcome differences. And so are they looking to create some kind of relationship? Remember, China wanted to put together the Silk Road, okay, reconstruct the old Silk Road and bring their goods in through this whole, it's sort of mythological, but it's also, there has some realities to it. And, President Xi under Biden had Meloni, the leader of Italy, kind of falling for this, right? They were having meetings. And then Meloni, now that she doesn't need that, she sort of stepped away. And Italy's doing fairly well, right? Southern Europe seems to be doing okay, probably better than Northern Europe in many ways. And so, she's sort of stepped back from President Xi. From everything I can tell, she's stepped back. It looked like she was kind of getting up pretty cozy to President Xi for a little while under the Biden administration, but now she's sort of stepped back, okay, because there's an alternative now. And here we see Macron, maybe he's stepping in and saying, what can I get out of China? And then what's in it for China, right? Obviously, some French trade goods, selling their things there. It's a scramble. Again, all these tariffs have stirred things up. And so now we're starting to watch the dust settle and see who the new alliances are that are going to form. And President Trump sort of put China out on an island, and then he pulls them back in, and then he puts them out on an island, then he pulls them back in. That's how I perceive it. Okay, so that kind of sets the stage. I just wanted to run this quickly just to give you a little flavor of, Macron in China with Xi, and obviously Brigitte's there. And, there's the customary handshake, and there's Brigitte, okay? And I don't know if he talks at all in here or not, or if this is just, them taking their photos. A lot of this stuff is always photo ops. The real negotiations go on behind the scenes with their staffs and their teams. And that's where the real agenda takes place. Not much really takes place at this level. This is all, customary handshakes and photos and things like that. Okay. So again, watching that, haven't heard much out of France in a while. And what kind of an alliance is being created here? Is this a one-off? Is this just every 2 years we have to go to China kind of a thing, or is there more to this? And so again, I'm just kind of watching to see these new alliances form. All right. So let's jump into this foreign direct investment. And I want to go to this. This is a little background on, again, this is a Bloomberg reporter, and obviously they're skewed. But it's a good, I don't mind it. I don't mind, because I know where Bloomberg's coming from almost 90% of the time. And so I'm just information gathering. I don't let them really get in my head. I just, but I like this perspective of challenging this $21 trillion foreign direct investment, because I do think it's hyped up. There's clearly hype in here. And this is what we want to do here, is break down why it's hype. Okay. And so here's the first one. We got 3 of these. Here's the first one.
If you look at all the investment pledges that the White House actually details, you're probably looking at about $7 trillion, which is a third of what President Trump says when he talks about $21 trillion. And we should say that $7 trillion comes with a lot of questions attached. A lot of what's in there is pretty amorphous. It's also, these are pledges that have been kind of amped up by CEOs and countries that have been sitting down to negotiate with the president.
I guess as we're thinking of how this impacts the economy, Sean, what is sort of a threshold that it still makes a difference? Like if $7 trillion still does come to realization, is that still a boom for the American economy?
Yeah, look, and that's the amazing thing about President Trump's kind of hyperbole, if you will, is that $7 trillion would still be a pretty historic influx of capital into the American economy over the next 4 years. That works out. If you look at the timelines of the pledges and so on, it looks like it would be about $1.5 trillion a year. That's into an economy that now sees about $5.4 trillion in investment in private sector investment annually. And if that came on top of that, that would be an extra 5% of GDP. And that puts it on par with some of the big kind of economic events in history. You know, the New Deal is somewhere around there. If you look at the railroad boom in the 1880s, it was up there. You know, some of the big fiscal interventions that we saw, the kind of rescue packages that we saw after the Great Recession in 2008, 2009, and also the pandemic response. So even at $7 trillion, at $1.5 trillion a year over the next 4 years, that would be enormous. But like I say, that still comes with huge questions. We don't know if that's going to be entirely new on top of what we already see in the economy, or simply it's companies and countries kind of saying, look, this is what we're doing already. Maybe we're going to juice it a little bit, and we see something more modest.
You know.
Okay, so what we're looking at here is supposedly, you know, the 21 trillion in investment, but when we add this up, we've got South Korea at 450 billion. We've got Japan, initial investment 600 billion, potentially talking $1 trillion, right? I've heard things go around, and again, that's a deal where they give us a blank check and then we get to spend it, and then there's a payback, a percentage of interest, and again, what's it going to be spent on? But it's essentially was a blank check to the Trump administration, okay? And so you have to wonder. And again, back into the defense side, the Asian Rim, you know, Japan leading this pushback against China regarding Taiwan and trying to create a NATO for Asia. Okay, that's kind of what I see coming, is the beginning seeds planted for some kind of a NATO on this Asian Rim. And then you get into all kinds of things. You know, where did NATO go wrong? Where did NATO go right? What would this thing do wrong? What would this thing do right if it forms? Those are the things we'll cover if they happen. But again, you know, that's what I see sort of happening here. You know, can that change the course of nature and the fact that we wouldn't have a war in 2028 or 2032 in that time frame? Again, according to these economic cycles that Martin Armstrong looks at and other people look at, and you can even see it coming together in the bond market to some extent. I look at these markets and I try to project out into that time frame, and the best you can, because you're looking out 6 years, you know, 3 to 6 years. And you're saying, would that make sense? And it can make sense, right? That can play out. All right. But you see, then we see the EU, right? The European Union giving 600 billion in foreign direct investment. We have India with about 500 billion. Qatar. And that adds up to what? Let's just say, let's give the benefit of the doubt. That's what? 2.5 trillion right there. Okay. South Korea, Japan, EU, and India, 2.5 trillion. Remember, President Trump that took that trip to the Middle East, one of his big landmark trips of this administration so far was that big trip to the Middle East. Again, Qatar, United Arab Emirates, Saudi Arabia. And out of there, he drummed up 1.2 trillion out of Qatar, 1.4 trillion out of United Arab Emirates. And the Saudis were at like 600 billion. But then Mohammed bin Salman was just at the White House last week for the Saudi Economic Conference and meeting with President Trump, and he upped it to $1 trillion. So you're talking about, what, 3.6 trillion out of the Middle East. So you're talking 3.6 plus, what'd we figure there? 2.5. So you're talking, you know, like what, 6 trillion maybe? And that's what this guy's saying. 7 trillion is even a stretch. The other thing with all this stuff is that they can make the commitment, but there's a lot of things that go into that, right? It assumes a lot of things. It assumes political stability. It assumes geopolitical stability. It assumes war, you know, economic stability. It assumes, military stability. It assumes a lot of things. And that's, look, I mean, that's what President Trump is trying to hang his hat on, is he's the peace leader of the world, trying to create peace all over the place, when we know that other entities out there were trying to create war and conflict, because it creates division, and then they get to control the chessboard or the monopoly board, and we don't, right? We don't have a stake in there. So again, that's what we're hoping for, is that somehow we can get past this with the peace, from a peace perspective. All right, here's the next clip on this, him talking about when will we know? That's the thing. How and when will we know how much is coming in?
Did you guys figure we're going to see receipts for this? Like, at what point will either you be proven right in a sense, or President Trump?
Look, it's gonna take a while. This is the kind of, if you will, the positive side of tariffs, right? There's been a lot of chatter recently about prices and affordability and the impact of tariffs on that. Well, the benefit of tariffs that President Trump has been talking about is this investment. When are we going to see that actually show up in the GDP numbers? And that's where we're going to be looking, laser focused on the kind of fixed investment line in the GDP figures. Like I said, that was around $5 trillion. That was the annual rate that we saw in the second quarter. Where's that going to go in the third quarter? We're going to see those numbers in a few weeks, and then into next year. The White House says, in response to our story, said, well, this is just media nitpicking. There are trillions of dollars in economic activity happening. And some of that is true. The question is it trillions of dollars in new economic activity? And is there going to be a big payoff for these tariffs, which right now the polls show voters aren't entirely enthused about?
Okay, so a lot of hot buttons there, tariffs, benefits, right? We know that's hung up in the Supreme Court. It's another big component to this Trump administration, the tariffs. And again, we saw President Trump the other day coming out and saying, at some point, okay, you won't even pay income taxes anymore, and it will be paid for by tariffs. Now, again, if I'm looking at it from, if I just listen and I don't think, then I say, wow, that's great. No income tax. Wow, okay. Then I think about the debt, and I'm like, okay, we don't pay down the debt. All we do is pay interest on the debt, right? And we ran that clip. Filippo, hopefully you found that, Filippo. I put it at the end of one of the shows, and I put it, I think I put it in a show the other day. Hopefully you ended up getting that thing. And I see Gordon puts a comment in here. The foreign direct investment numbers are somewhat nebulous, but still very large. That's true. And that's what this guy's saying. There's a baseline here, right? There's a baseline amount of foreign direct investment that comes in. And what we're looking for is outsized foreign direct investment. So he's saying there's a baseline amount. How much above that are we? And how and when will we know? Okay. And so if I look at this from a technocracy perspective and I hear you're not going to pay any income anymore, and you have all this debt, okay, and we have all these things that we have to pay for, unfunded liabilities, military, roads, infrastructure, all this stuff that we have to pay for, loans to this state, that state, for whatever. You can pay for it through sales tax, and you can pay for it through tariffs. And again, that's the beauty of a consumption economy, is that there's a lot of consumption, and as long as people are moving money, then there's lots of sales tax being generated, right? It's just this constant churning of money, and it's sales tax, clipped on everything except for, food and other non-taxable items. So how would this be paid for? And that just scares me when someone says there's going to be no income tax, because I love it, right? This gets back to before the central banks. It gets back to before taxation, because remember, taxation was a byproduct or a add-on to the Federal Reserve, and then came the income tax, okay? And so, because they needed that, right? Those things go hand in hand, right? They're hand in glove. They needed both of those. The key, though, here is when you get so dependent on a system as it is, how do you get off of that system? Well, one of the ways is tariffs. The other way is confiscation of things, whether it looks like a confiscation or not. There's $80 trillion sitting in the hands of baby boomers. I have a hard time believing that somebody in this world doesn't have their eyes on that, okay? And they're not looking at that as, hey, that's a pretty big enchilada out there. And we saw this with Bitcoin, right? We talked about this before it became a big thing in the media. We said, we kept talking about Michael Saylor and this structure that he put together. And we talked about that a little bit yesterday. Look, these financiers, right, or traders or whatever, traders, and, they will go for blood. I mean, they go for the jugular, right? And they will take things out if they can. And so when they see that $80 trillion sitting in the hands of baby boomers, it just makes me wonder, if you look at it from a heavy technocracy angle, you can see how they're setting the stage to basically confiscate all that, and then say, again, through a false flag or something else, and then say ultimately, like, hey, don't worry, we're the government, we're here to help. Okay, the famous words Reagan said, don't look to. We're the government. We're here to help. Don't worry about income tax. We're just going to pay you back out of your $80 trillion, that is now in this new entity that's out there, right? That's the heavy technocracy angle. And that's what I think, that's what scares me when I hear President Trump say, at some point, you won't even be paying income tax. And I love the idea. It's, when you're in a system like this, it's become so dependent on that, though. And that's the way things have worked for really 112 years since the formation of the Federal Reserve and the formation of income tax and so forth. This scam that basically was implemented back then. It's hard to get off of that, right? And that's the big question for me. Okay, here's our last clip on this foreign direct investment.
Railroad boom and the New Deal. This would be it would be about the same as, a little bit less than the railroad boom, but almost as much. Still, it's shocking that the COVID investment, the pandemic recovery money, was so much more, like double this boom. It's hard to believe that we spent that much. Is that like the same as what we would have spent during World War II, for example?
Look, in peacetime, it's significantly higher than you'd see normally. That doesn't kind of match what we get in World War II. When the country goes to war, it really pulls out all the stops, and we saw much higher influxes into the economy then. But in the peacetime economy, the pandemic was a war against a virus, right? So it's hard calling it a peacetime influx, but that really stood out. We also should remember that had consequences for the U.S. economy. A lot of economists blame that influx of capital, that fiscal impetus for driving the inflation that we saw in recent years, which also came at a political cost. So, if this investment that we see, if we see it, is not kind of productive investment, if it's into kind of bubble areas of the economy, then, perhaps that will drive more inflation and we'll be back to kind of totting up the costs of that. The other big thing that really stood out from our analysis here is just how dependent this investment boom is on AI-related investment. And we've seen in the markets just over the last few weeks a lot of concern about whether there's a bubble there. Well, we should also remember that there's consequences for the real economy. There's consequences also for President Trump's investment boom and whether it actually happens.
Hey, Sean.
Okay. So it's Bloomberg, and they can't help but, again, right at the end, he puts a dagger in and says, we'll see if it even happens. And again, quote unquote, Trump, Trump, Trump. It's just typical, right? So again, you have to kind of ignore those parts of it, and because they take any chance they can to shoot him down possible. And that's why we have to think he's doing some good things, right? Is that they take those times to shoot him down whenever they get the chance. Okay, so let's take a look at a couple economic things here. I wanted to take a look at this. Let's look at this thing right here. So here's some of our data coming out. We had today initial jobless claims. And there was one headline I saw right before the show I wanted to go back to if we can find it. So here's the initial jobless claims, and it's actually down less than expected. It was expected to come in at 220,000, and it came in at 191. And the 4-week average is 215. So you can see where these guys generate their number. They essentially just let the moving average generate it, and then they either maybe go a little above the moving average or a little below, and that's sticking their neck out. Okay, but the total combined continued weekly claims for benefits and all programs, 1.822 million. I'm not even sure what that means. Poor initial jobless claims revised higher from prior initial jobless claims revised higher, prior initial continuing claims revised lower. So again, that's just kind of mixed data. So there's not much in that. Let's take a look at this. That's kind of an interesting thing. Okay, let me see if I can find this one. Here we go. This was kind of interesting. And again, we need to get to this housing data. I've said that for the last week, but I need to hopefully we'll try to do that tomorrow. Okay, I can't believe Friday. Wow. I guess. Okay, it just doesn't seem like Thursday anyway. Okay. All right, but this is good. Somehow I lost a day or gained a day. I can't remember. I feel a day off. Okay. Redfin housing inventory is losing momentum. All right, so Redfin is this side outfit that does some research, and but here what they're saying is housing inventory is losing momentum with growth in total supply slowing down. New listings are stalling and delistings becoming more common. The pool of buyers is small, partly because we are entering the slow season for real estate, but it's also because houses are expensive, rates are elevated, and people are feeling cautious about their pocketbooks. said Carlos Castillo, Redfin Premier agent in LA. House hunters may be able to find a deal because there are more sellers than buyers, but I'm advising buyers to be strategic. For instance, buyers can ask for concessions and so forth. Okay. And then here we have Zillow, right? Zillow's out with a housing market will warm up in 2026 with more sales and modest price growth. Rent affordability is expected to improve in 2026. So again, this goes back into what Basant was saying. Again, the housing, roof is a very important thing to pretty much everyone, whether they're renters or homeowners. And so again, for a good 2026 and for affordability, for people to feel it, this is something that helps. Again, energy is a big component, food's a big component, and and this is a big component, right? The housing costs and living costs. So here they say the housing market is finally settling into a healthier state with buyers and sellers starting to return. Okay, so again, that guy just said it was out of balance. Here they're kind of saying it's more imbalance. Said the chief economist at Zillow, buyers are benefiting from more inventory and improved affordability, while sellers are seeing price stability and more consistent demand. Each group should have a bit more breathing room in 2026. So 2026 is shaping it up to be the slowest year for single-family home construction starts since 2019. Okay, so it gives a little bit on the. I wanted to go through those because I saw those coming through this morning, and it gives us a little bit of a vibe for what's going on in this housing market. Again, according to Redfin, which is a big player in that space, and of course Zillow, which is a big player in that space. Okay, and let's see here. Let's take a look at a couple charts. All right, let me come over here. Couple things have happened. Haven't happened yet, but I wanted to show this because when we went from the September contract to the December contract in these futures, remember we had two signals in. We had this Dow signal at 47,797, and we had the S&P up to 6909. Okay, those were the two on the September futures contracts rolling to the December. And the December had gotten to the full upside objective when the September hadn't yet. So it gave us a lead to get an indication. And usually, right, the next contract out is going to be higher than the current contract because you have things in there, right, that go into that. At some point, maybe we'll break that down. What are the different components that typically create a gap between the current futures price and the next month futures price? When those get out of whack, right, you get these things, and we have covered this in here before, it's been a while, but contango and backwardation, okay? And so you look at these futures contracts, and normally the next month out is going to be higher, right, especially in stocks because you have interest costs and all these other things that go into it. But what I wanted to do is not get caught on this, get caught out on this time around and look at this. Okay, so here's what we've got. This Dow, right, came screaming back up. The other day it came up and hit this 47,797, okay, right up in here. Let me just throw a little rectangle over this. That's another thing on the list, clean all these charts up. Okay, so here we go. We got this little yellow square, right, came up and hit that 47. It's not the first time it's been up there, right? We saw it blow through back here, came screaming through, spent some time above, come screaming back down through it. And again, this goes back to that September contract roll back in here. Got up to the 47,797, spent some time up in here, right? This time frame here is October 29th. So again, not that long ago. We're definitely deep into that September deep. We were already deep into the December contract then. Okay, so 47,797 was important, kind of got blown through here. This to me was concerning, right? Where that magenta box is at, because it blew right through that 47,797. It's like right here, you want to give it a shot again on a retest. And when you see something like that, it comes back into that 47,797. I would tend to be a buyer here, right? As it comes back into this area. Now, it wouldn't have worked, right? You would have gotten blown through. So this is why you have to manage the risk. Give it a try. If it starts to work, then you get on the train and you start getting active, right? Again, from a trading perspective. Same thing from an investing perspective. It's just, got to dial it back a little bit and take a different perspective. Anyway, we come screaming down through there, so that idea would not have worked. We would have gotten blown through. Okay, then it goes way down, all the way back down in here. And remember, back in there, I think we were thinking more about, are we forming some kind of a top? This area right here, it would be very hard to make a case, in my mind, that that you would be getting really bearish. Although it would have worked, it would have been hard to make that case up in there. Okay, so that being said, we come back down, again, residual structure. So you can only, once the signal gets older like this, it's like the rock. Throw it in the water, out to the shore, it's predictable. Once it bounces off the shore and it comes back, it becomes less predictable, right? We're talking about overtones here. Different, not as pure of harmonics here. Okay, so market goes back up to the 47,797 just the other day, okay, last week on the 28th of November. Sells off a little bit, comes back down into here. Looks like the 5/8, kind of hovers around in this area. I've marked it up a couple times. We had momentum above the risk curve. So again, the trend's looking pretty good on the upside, and sure enough, we break through. Okay, this is still on the December contract. Now, over here, I have on the side, this is the March contract. Okay, so this is going to be the March contract in 2026. This is the next contract coming. And it's already at 48,320. Okay. So let's just mark where that's at on here. 48,320, 48,320. Okay. So this is right here is where the March contract's at. Okay. Where that little yellow sliver's at. So this is a December contract where it's at right now. And this is the March contract up in here. Okay. So that's that gap we talk about. Looking out in the future, that gap up. So both of these contracts are above that 47,797. This has been messy. I'm not going to, again, I think we're at this dividing line of what's going to happen. Are we going to get, and we've been saying this, if we get back above this 47,797, we could see a run to 50,000 into year end, ticker tape parade, the ball's dropping. And not only is the ball dropping on New Year's, but they're saying we hit 50,000. Now, we only have a few weeks to do that, so it would have to be a big run. Now, other thing, I don't know if I have this chart available or not. If I do, I'll show it. Where would that thing be? We've got these symmetric moves that I've been showing. Here it is. I think it's filling in now. We talked about this the other day. If you're at 48.3, you're only 1,700 points away in the Dow. Okay, so look at the symmetry that we have here. These yellow boxes, I think we figured these were what, 46. Let me just grab one of these, an easier one. So this thing's like, maybe this one's easier. 45, 410, 47. So it's like 1,500. So I think these yellow boxes are like 1,500 point swings. The green boxes are slightly bigger, but you can see there's 1, 2, 3, 4, 5 yellow boxes on here, all the same size, right? All those swings are the same size. So this is symmetry in markets. And then we have the light green ones. There's 3 of them on there. They're all the same size. They're slightly bigger than the yellows, but they're all the same size. Okay. And that encompasses most of the trading activity during this, window of time, all the way back in here from, early September until, right now, which is what, early December. So September, October, November. So a good 3 months, right? At least 3 months. We've seen multiple 1,500 point swings. So when we go back to this, right, it's not that absurd to think that 1,500 points in this thing is, 15 to 1,700 points pushes this market to that 50,000. Okay. That big pie in the sky, the big psychological target. So it's not out of question to see this thing, at the end of this year or early into 2026, some kind of a move to 50,000, right? A big psychological level. Now, if it gets there, I can assure you, I will be trying to short it. Again, I don't know what's going on at that point in time. I don't know what the future is, but if we get that kind of a blow-off rally in here, again, it depends what it looks like. I can't just say that for sure, but my gut tells me right now I would be thinking about the short side of this market at that point, okay? Things can change, but I'm not ruling out the fact that we could, again, if it holds above 47,797, okay, on the December and or the March, which it's both contracts are above that white dash line, the 47,797. Then this 50,000 is in play, okay? And I don't know if I have this. I think I do. I'll run this today because I meant to run this. This is perfect for equity day. And if not, I'll load it up. And that's what we'll finish up with here. But the key is, let's take a look at this S&P. All right, this will give us a little bit more. The 6909, the Dow's clearly leading, okay, relative to the harmonic structures. Both the December and the March are above 47,797. The same corresponding signal on this S&P is at 6909, all right? And the December contract, the one that we're looking at right now, is sitting right here. It's still below, okay? That's where it's at. Now, if we look at the March contract on this, the March 2026 contract, it's at 69.32. Let's just show that 69.32. So it is sitting right there. So it's above, okay? So it's above the 69.09. Now, residual harmonics, caution, but the March is above, the December isn't, okay? Both are above on the Dow, okay? It's looking fairly good on the upside that we could see, again, another consumer-driven Santa Claus rally into the end of the year. And if it doesn't work, if something fails, what are we watching? 47,797, 69.09, okay? And then hopefully we'll get some new stuff to actually introduce in here as well that we can watch to also manage the risk against. So we're not just blindly doing this. At least I don't want to blindly, get long this, but this Dow is looking really strong. Okay. Really, really strong right now relative to the other markets. Now let's take a look at this one. You can see this S&P is just ripping right now. This is the 40-tick chart over in here, and you can see it's just going straight up, and it's pre-market. It's just, you can see that thing just climbing like crazy. They're just coming and buying the heck out of this. Now let's see if there's anything that came out in the news, or if that's just, just insane buying here. I don't know why I can't get to that. Let's see if there's anything that, no, I don't see anything popping through the news. So again, this is just people front running this, right? And this is what the futures markets do. When people want to get risk on, they go to these futures markets. And then what they tend to do is come back and sell. As they sell those futures off, they can maybe pick up things that they think are, that they really want to hold, That's how the fund managers do it. Anyway, so you can see that's a pretty significant move going into the open here, right? Pretty good run up from 68.62 to 68, 80. So a 20-point move in the S&P. I don't know what that equates to in terms of dollars, but it's significant. This is real money coming in, okay? And it seems to be. Again, always looking for places to manage the risk against. Okay, let's look at this. Take a peek at this thing because we had this level in here, this 24,165, clearly way above that. Okay. In this NASDAQ, this chart's going to take a while to fill in. I think we did get a retest of this recently, though. There it was. So we came down and hit this 24,165. And now, you can see it hits it and off it goes, right? So this market's ripping as well. All right. And then we have this, the Russell. Let's take a look at this one. This is the small cap to mid cap one that we've been watching. There we go. Okay. And let's look at something a little. Here's the daily chart, right? This is the daily Russell 2000. And we talked about this, initial high, second high, third high, all at the same level, breaks through on the fourth try, comes back down, retests that level, and now it's looking fairly strong. That thing's sitting right here. Okay. Let's just take a look at something more internal. So you can see it's also ripping this morning. They're coming in and buying this thing as well. So again, all these indexes look pretty strong. The thing we always question, the thing that I question is this consumer going to come in again? You know what I mean? And is this, there have been comments in here on the amount of debt. There have been comments in here on, and I think they're right. They're well-founded. And, Scott Bessent's on here telling us, though, that we're setting up for a great 2026. This guy has probably the biggest tool belt, especially with the Fed being weakened and Kevin Hassett going in there. The Fed isn't what it was, I think, under Ben Bernanke and Janet Yellen, fortunately, especially Janet Yellen. But But the Fed's changing dynamics here, I think, right? I think something's changing at the Fed. And with Kevin Hassett going in there, assuming that he is the guy, and Scott Bessent running the National Economic Council, and Scott Bessent also at the Treasury, the Secretary, that guy's got a lot of he's got a lot of weapons on his hip, okay? A lot. And with Kevin Hassett sitting there ready to pull any trigger needed, it'd be hard. It's hard, even though at some point this thing's gonna, can we grow into it? I guess that's the thing. Is the only way out of this is to actually create growth, hopefully create some kind of control on this expenditure side. Because I saw, I saw Crash and Splash in here saying I'm betting on more debt, and it's hard to not bet. It's hard to not bet toward that. Why am I not getting this thing? Oh, it's this one. Maybe it's that one. Okay. Yeah, Crash and Splash was saying here, 10 trillion of debt under Trump's first term. I'm not sure Trump is very good with his checkbook. And then he said, not expecting anything but more debt. So again, that's when you look at that debt clock, right? The debt clock's running, it's ticking. And so how do we curb that? Can we, and we're going to give handouts to people, we're potentially going to give money back through tariffs. I mean, something doesn't add up here. But we can't ignore the fact that Scott Bessent, there's been a transfer of some power from the Fed to the Treasury, and this guy's sitting there with a lot of weapons on his hip, and he can pull a lot of triggers. And is it ultimately good? Is it ultimately bad? It's probably going to end up with tears. But in the meantime, this thing could go crazy. He's calling for 2026. He laid it out in that clip in 2.5 minutes. He laid out all the things that all the groundwork they've put out there for this. I don't like it. I wish this market would come off, right, and sell off a little bit and see if it can take it. Can this thing take a 10 or 15% hit? And I hope that it could. But I feel like if we start to go over, it's just going to snowball. You know what I mean? And that's why we just keep injecting and injecting and injecting and injecting. If we can't do it with the Fed anymore, we come over here and we do it, So that's my big concern. Now, in the meantime, as a trader, as an investor, I think it's hard. I mean, it's hard as an investor now because it's hard to get behind, what you see going on in the AI space. And you're investing in something that could be your own doom, so it's hard, Then again, it's the greatest, it could be the most productive technology that man's ever seen, What are we going to do with it? There's all these questions. It's really hard to be an investor. Sometimes, look, the people who just go to work and they throw money in a 401k and they don't even think about it. I mean, look, they've been very fortunate for a long period of time. Will that change? Or is it just going to continue like that where you don't even have to look at it? You just set it and forget it. I think at some point something bad's going to happen and that's going to all get taken away. Again, 80 trillion sitting out there is a big target for, just like we saw with Bitcoin and with Strategy and Michael Saylor and all these others, and even Eric Trump's American Bitcoin, right? I mean, it took a 40% hit in 30 minutes. Those are the kind of things that send, chills down my spine that, it's very hard to be fully invested in a stock market like this. And that's why I like to look at these markets from trading perspective. And I know not everyone can do that. But maybe what we can do in 2026 is we can start looking at a balanced portfolio where we have some longs, these things look good, and some things shorts, right? And we talk about, and then we have a neutral. That way, if something really bad happens, half of what you have is, or a percentage, is built to take advantage of that on the downside. And if it goes up, part of it's built to take advantage on the upside. And if you make good selections, like buy this stuff undervalued and sell this stuff when it's overvalued, you're also getting this effect where these things can actually come together, right? Even though, if you get the big sell-off, obviously you're protected. If you get the big run-up, you're protected. You're not loaded to the gills, you're not going to make as much as everybody else, but more than likely, but you also have the protection and you have the ability that these things can keep coming together. If you keep selling overvalued and buying undervalued, hopefully you get this effect too, where things just keep coming back together, as a nested product inside of that. So I think that's where I've always wanted to go with the show. It's just hard to put all that together because I have a hard time just getting this together and getting clips, but I'm getting more efficient at that. Again, thanks to Rachel, thanks to working through some of the stuff. I still have a few things to work through, but if we can get that stuff set up and a little bit of help from, a few others that have volunteered to help with some stuff, that's the kind of stuff that I want to try to bring to this because I just, that way, I can't say no matter what happens, but that kind of mindset is a good mindset, I think, going into this. Trying to sell overvalued stuff, trying to buy undervalued stuff. Kind of like we've done with crude oil, right? Crude oil going down, natural gas going up, right? We've been pretty good on that one. And, and someone who's an investor could have been a part of that, right? There's an example for us to work off of. We said we're net neutral energy, okay? Crude oil going down, natural gas going up. It's worked like a charm, all right? And so the key is to do more and more of that, right? Find things that you can think are going down, find things you think are going up, and benefit from both sides of it. And still, you're not out of the game. You're still invested, but you're also protected. So, all right, with that, I think that's good for today. We'll come back tomorrow, look at some stuff on commodities, maybe even circle back on some of this. Even Saki. She's gotten in my head. We'll come back and we'll look at stuff on the commodity side and I need to do some work on that too, because I think for our roundtable on the 21st, I think it is, we're going to do technocracy and food around the whole food space. And I think I heard someone was telling me the other day, Patrick Wood is actually doing some stuff on that. So he's out there. The guy, he's good. He pounds the pavement. He does a lot of work. He's really good. All right. With that, everyone, have a blessed day. And I'm going to try. I think I have this thing ready to go. I think this is the one I wanted to play yesterday on the fundamental calls for the equity space.
This is a new product that we just announced at the Army's conference yesterday. We've been working on it for years. It's called Eagle-Eye.
Yeah. So our story for next year is a continuation of what this year has been, essentially, which is that we essentially got a kitchen sink in the first quarter. We made a significant, bear market low in April. That was the end of an economic cycle. I believe that there's now a rolling recovery. Okay, all of the policy changes that we've seen really affect a much stronger 2026 from an economic standpoint. And a lot of that has to do around this investment cycle. So our target's 7,800. That's the base case for 2026. We've written about this as well. I think the very near term, we still have to get over this big hurdle, how the Fed is going to transition to being more dovish. Does that require weaker labor data, or does that require maybe more financial kind of stress in the funding markets? We'll see, what the catalyst is there. That could create some near-term opportunities, but we're a buyer of that dip if we get it.
Go back to the inflection point. What changed your view? Because now you're one of the biggest bulls on Wall Street.
Well, it's just flexibility. I mean, it's funny how you get a reputation. You go from biggest bull to biggest bear, and we've had that over the last 10 years, quite frankly. So it's not new for us. I mean, we're happy to go either way, depending on what our work shows. Most recently, in the last year, what's really changed for us is the earnings revisions, okay? So like this year, it looks much different. The earnings revision breadth is tremendous. I mean, that's the story, and I think that's the story that most people are still missing. And everybody's focused on valuation. It's like, look, valuations are okay if earnings are going to beat on the upside. And that's our call for 2026, is that we're seeing a broadening out in the earnings story. And we should see a broadening out in the equity story as a result of that. So we're very disciplined around our work. I mean, whether it's sentiment or positioning or, valuation or earnings revisions, I mean, we look at everything, Matt. And I think it's just, at this point in time, it looks pretty supportive from a policy standpoint, from an earnings revision standpoint, and in valuation, you grow into it.
Was gone. There was no train station. There was no downtown. Somehow it disappeared.